Imagine an entire region, a place everyone was calling an economic miracle, suddenly just brought to its knees. That's exactly what happened in 1997. The Asian financial crisis wasn't just some dip in the market. No, this was a catastrophic collapse. We're talking currencies, huge corporations, entire economies, falling one after the other, just like dominoes. And to really get how this miracle turned into such a nightmare, we've got to start with one simple but absolutely fatal idea.
Okay, so this whole story, it really hinges on this one concept, currency mismatch. I know, it sounds a little technical, but the idea is actually pretty straightforward. Picture this. You borrow money in stable, strong US dollars, but your business makes all its money in your local currency, save the Thai baht. Now, as long as that exchange rate stays the same, everything's fine. But what happens when it doesn't? This one single vulnerability, it's the key that unlocks this entire crisis.
All right, so let's set the scene. It's the early 1990s, and economies like Thailand, South Korea, and Indonesia, well, they were known as the Asian tigers, and they were absolutely roaring. We're talking incredible growth, massive amounts of foreign investment just pouring in. On the surface, it looked like a picture of unbelievable success. But, just beneath that shiny exterior, a really critical flaw was growing bigger and bigger.
So you really have two sides to this whole economic miracle coin. On one side, you've got the promise, amazing growth, tons of investment coming in, and currencies that were pegged to the US dollar, which seemed like a guarantee of stability. But then you flip that coin over, and you see the peril. Companies and banks taking on these huge, short-term loans, all in US dollars, while every dime they earned was in their own local currency. See, that's the currency mismatch we were just talking about, but now we're seeing it on a massive, countrywide scale.
And this right here is the fatal combination. Because countries like Thailand had pegged their currency to the dollar, it created this massive false sense of security. Everybody thought, hey, what's the risk? Borrowing in dollars is cheap and it's totally safe. It was like a collective blind spot, encouraging all these companies to just pile on foreign debt without even thinking about what would happen if that peg ever broke.
The whole system was just so fragile, like a ticking time bomb, really. And in 1997, well, the clock ran out. The trigger wasn't a slow burn, it was an explosion. And it all started in one place, Thailand.
And when it happened, everything fell apart with just shocking speed. In May of '97, you have these big international speculators who start betting against the Thai baht, basically saying, hey, this currency is way overvalued. The government spends billions trying to defend the peg, insisting, nope, we are not going to devalue. But by July 2nd, it was over. Their foreign reserves were gone, they had no choice but to give up, and the baht immediately went into a total freefall. Just 1 month later, Thailand was at the IMF store asking for a bailout.
But here's the thing. The collapse of the Thai baht, that wasn't just some isolated event. No, it was the spark that ignited a firestorm across the entire region. See, investors looked at what happened in Thailand, and they suddenly saw the same hidden flaws everywhere else.
What happened next was just pure, uncut panic. That huge river of foreign investment that had built up the Asian tigers, it suddenly reversed course and flowed right back out, almost overnight. Investors didn't stick around to ask if, maybe South Korea or Indonesia were different. They just pulled their money out of the whole region, terrified that the same currency mismatch and weak banks were hiding everywhere.
And the devastation, it was just breathtaking. I mean, look at these numbers. In just 6 months, the Thai baht and the South Korean won lost half their value. The Indonesian rupiah collapsed by a staggering 80%. This wasn't a market correction. This was a complete and total wipeout.
Now let's tie this right back to our key concept. Remember all those companies borrowing in dollars but earning in their local currency? Well, overnight, their debts basically doubled. Or, in Indonesia's case, they quintupled. But their revenue, it stayed exactly the same. You can imagine what that does to a balance sheet. They were instantly destroyed. And this is what triggered those huge waves of bankruptcies, mass layoffs, and a really deep, painful recession all across Asia.
So in the aftermath of all this devastation, the world was basically left asking a simple question that had a very, very complicated answer. How on earth did this happen? And maybe more importantly, how do we fix it?
So yeah, who was to blame? The whole debate really centered on this one key question. Was this a problem that was born from within Asia itself, or was it caused by these powerful external forces in the global financial system?
The arguments pretty much fall into two camps. One side points to domestic issues, weak banks that weren't properly supervised, and this thing called crony capitalism, where loans were given out based on who you knew, not on whether you could actually pay it back. The other side points to international factors, the pure volatility of global money that can just flood into and out of a country, and those rigid exchange rate systems that created that false sense of security to begin with. The truth? Well, like it often is, it's probably a mix of both.
So what did they learn from all this? Well, Asian economies got to work on some major reforms to build a much stronger foundation for the future. They totally cleaned up their banking systems, they put in much stricter rules for managing foreign debt, and, this is crucial, they began to build a massive financial shield to protect themselves. The crisis of 1997 is history now, but its legacy is, well, it's profound. It fundamentally reshaped how these countries see the global economy and their role in it.
The psychological impact was just enormous. The bailouts from the IMF, they came with these really harsh conditions, austerity measures that were deeply painful and felt like a total loss of their economic sovereignty. That whole experience created this powerful collective resolve across Asia that basically amounted to two words: never again. Never again would they be so vulnerable to the whims of global investors or the demands of international lenders.
And that never again resolve translated directly into a brand new strategy: self-insurance. Asian central banks started buying up US dollars and other foreign currencies like crazy, creating these enormous war chests of reserves. The idea was simple. If another crisis hits and all that foreign money starts to flee, they can use their own reserves to defend their currency and their economy, without having to go cap in hand to the IMF.
And this is exactly why the lessons of 1997 are maybe more relevant today than ever. Sure, those massive reserves in Asia are a strong buffer, but that core vulnerability, borrowing in foreign currency, it hasn't just disappeared. So it leaves us with this pretty chilling question. As the US and other major economies raise interest rates, which makes the dollar stronger and dollar-based debt more expensive to repay, are other emerging markets around the world at risk of facing their very own 1997 moment? It's a thought that, you can bet, is keeping policymakers up at night.